Hello, everybody. Thank you so much for tuning in today. This is the Bodega Cat Book Club Financial Edition. And today we're continuing our reading of The Creature from Jekyll Island by G. Edward Griffin. And the subtitle is called A Second Look at the Federal Reserve. So I hope you guys are enjoying this book. This is a massive book. It's over 600 pages. And we are almost to the tail end of it. So I commend all of you who stuck with us and who read the book with us from since the beginning. Before we begin, I just want to do a couple of plugs. We have other book clubs that you can join us if you like this format. On Mondays, we have our spiritual book clubs. Wednesdays, we have our health book clubs. And of course, Thursdays, we have our financial book clubs. If you have any books that you want us to read, that you want to recommend us to read, for anything, whether it's spiritual, health, or financial, I'll leave a link in the description box below, and you can recommend it, and we will consider it. Reading is a lost art, and I think it's important to get back to reading, in my opinion. So we put all the books that we've read in the past, as well as current books, on our YouTube channel, as well as podcasts. We have podcasts that we put out once in a while where we interview interesting people. So you could check out our YouTube channel and please like, share, and subscribe and all those good stuff and leave a comment. And yeah, so uh we also put our podcast on our website as well. So you could check out our website. We have a newsletter that we put out once a month for free. So please sign up for that as well. And if you find this valuable, if you find value in what we're doing, please support us by buying me a coffee or checking out our merch. Um, we have a dedicated shop tab on our website, and we're coming out with new designs every month, and especially the holidays. We've got the holiday designs out already. So please check us out and support us that way. And if you are local in the Los Angeles area, or if you're traveling for, business or pleasure or whatever, um, come meet us, come visit us in person. We have a healing center that we use technologies based on Nikola Tesla's scalar wave research for holistic healing for both domestic animals, cats and dogs, as well as humans. So check us out there. We have all the information on our website, so you could read all about it and learn more about it, as well as our other services that we provide as well. So yes, so come join us. There's many ways to connect, and we'd love to hear from you. Okay, so this is a continuation of The Creature from Jekyll Island. And this is chapter 23, and this will be part one. Okay, so if you have a book, you could follow with us there. If not, you can follow with us here on camera. Or just listen if you're driving or jogging or in the gym or whatever. You could do that as well. Whatever works for you. There is no one way to do things. So, all right. So here we go. I think the camera is okay. Let me move it in a little closer here. Maybe not that close. Okay. Chapter 23. And like I said, this will be part one. The Great Duck Dinner. How Federal Reserve policies led to the crash of 1929, the expansion of the money supply as a means of helping the economy of England, the resulting wave of speculation in stocks and real estate, evidence that the Federal Reserve Board had foreknowledge of the crash and even executed the events that were designed to trigger it. The story is told of a New England farmer with a small pond in his pasture. Each summer, a group of wild ducks would frequent the pond. But try as he would, the farmer could never catch one. No matter how early in the morning he approached, or how carefully he constructed a blind, or what kind of duck call he tried, somehow those crafty birds sensed the danger and managed to be out of range. Of course, when fall arrived, the ducks headed south, and the farmer's craving for a duck dinner only intensified. Then he got an idea. Early in the spring, he started scattering corn along the edge of the pond. The ducks liked the corn, and since it was always there, they soon gave up dipping and foraging for food of their own. After a while, they became used to the farmer and began to trust him. They could see he was their benefactor, and they now walked close to him with no sense of fear. Life was so easy, they forgot how to fly. But that was unimportant because they were now so fat. They couldn't have gotten off the water even if they had tried. Fall came and the ducks stayed. Winter came and the pond froze. The farmer built a shelter to keep them warm. The ducks were happy because they didn't have to fly. And the farmer was especially happy because each week, all winter long, he had delicious duck dinner. That is the story of America's Great Depression of the 1930s. Consolidation of power. When the Federal Reserve Act was submitted to Congress, many of its most important features were written in vague language. Some details were omitted entirely. That was a tactical move to avoid debate over fine points and to allow flexibility for future interpretation. The goal was to get the bill passed and perfected later. Since then, the act has been amended 195 times, expanding the power and scope of the system to the point where today it would be almost unrecognizable to the congressmen and senators who voted for it. In 1913, public distaste for concentration of financial power in the hands of a few Wall Street banks helped to fuel the fire for passage of the Federal Reserve Act. To make it appear that the new system would put an end to the New York Money Trust, as it was called, the public was told that the Federal Reserve would not represent any one group or one region. Instead, it would have its power diffused over 12 regional Federal Reserve banks, and none would be able to dominate. As Galbraith pointed out, however, the regional design was, quote, admirable for serving local pride and architectural ambition and for lulling the suspicions of the agrarians, end quote. And that quote was from Galbraith, page 130. But that was not what the planners had in mind for the long haul. In the beginning, the regional branches took their autonomy seriously, and that led to conflict with members of the National Board. The Board of Governors was composed of political appointees representing diverse segments of the economy. They were outclassed by the heads of the regional branches of the system, who were bankers with bankers' experience. Return of the New York, quote, Money Trust. The greatest power struggle arose from the New York Reserve Bank, which was headed by Benjamin Strong. Strong had the contacts and the experience. It will be recalled that he was one of the 7 who drafted the cartel structure at Jekyll Island. He had been head of the J.P. Morgan's Bankers Trust Company and was closely associated with Edward Mendel House. He had become a personal friend of Montague Norman, head of the Bank of England, and of Charles Rist, head of the Bank of France. Not least of all, he was head of the New York branch of the system, which represented the nation's largest banks, the money trust itself. From the outset, the National Board and the regional branches were dominated by the New York branch. Strong ruled as an autocrat, determining Fed policy often without even consulting with the Federal Reserve Board in Washington. The United States' entry into World War I provided the impetus for increasing the power of the Fed. The system became the sole fiscal agent of the Treasury. Federal Reserve notes were issued. Virtually all of the gold reserves of the nation's commercial banks were gathered together into the vaults of the Federal Reserve of the federal system, and many of the legislative restraints placed into the original act were abandoned. Voters ask fewer questions when their nation is at war. It's an interesting sentence, isn't it? Voters ask fewer questions when their nation is at war. Maybe that's why they want us at war all the time, so we don't ask questions. The concentration of power into the hands of the very, quote, money trust the Fed was supposed to defeat is described by Ferdinand Lundberg, author of America's 60 Families. Quote, in practice, the Federal Reserve Bank of New York became the fountainhead of the system of 12 regional banks, for New York was the money market of the nation. The other 11 banks were so many expensive mausoleums erected to salve the local pride and quell the Jacksonian fears of the hinterland. Benjamin Strong, president of the Bankers Trust Company, J.P. Morgan, was selected as the first governor of the New York Reserve Bank. An adept in high finance, Strong for many years manipulated the country's monetary system at the discretion of directors representing the leading New York banks. Under Strong, the reserve system, unsuspected by the nation, was brought into interlocking relations with the Bank of England and the Bank of France. And that quote, end quote. And that quote was from Lundberg, page 122. Bailing out Europe. It will be recalled from chapters 12 and 20 that it was this interlock during World War I that was responsible for the confiscation from American taxpayers of billions of dollars, which were given to the central banks of England and France. Much of that money found its way to the associates of J.P. Morgan as interest payments on war bonds and as fees for supplying munitions and other war materials. 70% of the cost of World War I was paid by inflation rather than taxes, a process that was orchestrated by the Federal Reserve System. This was considered by the Fed's supporters as its first real test, and it passed with flying colors. American inflation during that period was only slightly less than in England, which had been more deeply committed to war and for a longer period of time. That is not surprising, inasmuch as a large portion of Europe's war costs had been transferred to the American taxpayers. After the war was over, the transfusion of American dollars continued as part of a plan to pull England out of depression. The methods chosen for that transfer were artificially low interest rates and a deliberate inflation of the American money supply. That was calculated to weaken the value of the dollar relative to the English pound and cause gold reserves to move from America to England. Both operations were directed by Benjamin Strong and executed by the Federal Reserve. It was not hyperbole when President Herbert Hoover described Strong as, quote, a mental annex to Europe, end quote. And that quote was from Galbraith, page 180. Before Alan Greenspan was appointed as chairman of the Federal Reserve by President Reagan in 1987, he had served on the board of the J.P. Morgan Company. Before that, however, he had been an outspoken champion of the gold standard and a critic of the system's subservience to the banking cartel. In 1966, he wrote, quote, when business in the United States underwent a mild contraction in 1927, the Federal Reserve created more paper reserves in the hope of forestalling any possible bank reserve shortage. More disastrous, however, was the Federal Reserve's attempt to assist Great Britain, who had been losing gold to us. The quote Fed succeeded. It stopped the gold loss, but it nearly destroyed the economies of the world in the process. The excess credit which the Fed pumped into the economy spilled over into the stock market, triggering a fantastic speculative boom. As a result, the American economy collapsed, end quote. And that quote was from Greenspan, page 99 to 100. After his appointment to the Fed, Greenspan became silent on these issues and did nothing to anger the creature he now served. Wow, what hypocrisy. Interesting. Okay, agents of a higher power. When reviewing this aspect of the Fed's history, questions arise about the patriotic loyalty of men like Benjamin Strong. How is it possible for a man who enjoys the best that his nation can offer, security, wealth, prestige, to conspire to plunder his fellow citizens in order to assist politicians of other governments to continue plundering theirs? The first part of the answer was illustrated in earlier sections of this book. International money managers may be citizens of a particular country, but to many of them, that is a meaningless accident of birth. They consider themselves to be citizens of the world first. They speak of affection for all mankind, but their highest loyalty is to themselves and their profession. That is only half the answer. It must be remembered that the men who pulled the financial levers on this doomsday machine, the governors of the Bank of England and the Federal Reserve, were themselves tied to strings which were pulled by others above them. Their minds were not obsessed with concepts of nationalism or even internationalism. Their loyalties were to men. Professor Quigley reminds us, quote, "It must not be felt that these heads of the world's chief central banker, let's try that again. Quote, it must not be felt that these heads of the world's chief central banks were themselves substantive powers in world finance. They were not. Rather, they were the technicians and agents of the dominant investment bankers of their own countries, who had raised them up and were perfectly capable of throwing them down. The substantive financial powers of the world were in the hands of these investment bankers, also called international or merchant bankers, who remained largely behind the scenes in their own unincorporated private banks. These formed a system of international cooperation and national dominance which was more private, more powerful, and more secret than that of their agents in the central banks. End quote. And that quote was from Quigley, Tragedy, page 326 and 327. So, we are not dealing with the actions of men who perceive themselves as betraying their nation, but technicians who are loyal to the monetary scientists and the political scientists who raised them up. Of the two groups, the financiers are dominant. Politicians come and go, but those who wield the power of money remain to pick their successors. Farmers become duck dinner. During the war, prices for agricultural products rose to an all-time high, and so did profits. Farmers had put part of that money into war bonds, and much of it had been placed into savings accounts at banks within the farming communities, which is to say, mostly in the Midwest and South. That was unacceptable to the New York banks, which saw their share of the nation's deposits begin to decline. A way had to be devised to reclaim that money. The Federal Reserve System, which by then was the captive of the New York banks, was pressed into service to accomplish the deed. Few of those country banks had chosen to become members of the Federal Reserve System. That added insult to injury, and it also provided an excuse for the Fed to wage economic war against them. The plan was neither complex nor original. It had been used many times before by central bankers. It was, one, extend easy credit to the farmers to lure them into heavy debt, and then two, create a recession which would decrease their income to the point where they could not make payments. The country banks then would find themselves holding non-performing loans and foreclosed property, which they could not sell without tremendous losses. In the end, both the farmers and the banks would be wiped out. The banks were the target. Too bad about the farmers. So the farmers was collateral damage, right, as they call it. Wow, that's terrible. Congressman Charles Lindbergh Sr., father of the man who made the world's first solo transatlantic flight, explained it this way, quote, under the Federal Reserve Act, panics are scientifically created. The present panic is the first scientifically created one, worked out as we figure a mathematical problem, end quote. And that quote was from Charles A. Lindbergh, Sr., The Economic Pinch, 1923, RPT, I think that's report, Hawthorne, California, Omni Publications, 1968, page 95. The details of how this panic was created were explained in 1939 by Senator Robert Owen, chairman of the Senate Banking and Currency Committee. Owen, a banker himself, had been a co-author of the Federal Reserve Act, a role he later regretted. Owen said, quote, in May 1920, the farmers were exceedingly prosperous. They were paying off their mortgages, they had bought a lot of new land at the instant of the government, had borrowed money to do it. And then they were bankrupted by a sudden contraction of credit and currency, which took place in 1920. The Federal Reserve Board met in a meeting which was not disclosed to the public. They met on the 18th of May, 1920. It was a secret meeting, and they spent all day. The minutes made 60 printed pages, and it appears in Senate document 310 of February 10, 1923. Under action taken by the Federal Reserve, under action taken by the Reserve Board on May 18, 1920, there resulted a violent contraction of credit. This contraction of credit and currency had the effect the next year of diminishing the national production 15, I think that's billion, $15 billion. It had the effect of throwing millions of people out of employment. It had the effect of reducing the value of lands and ranches, $20 billion. End quote. And that quote was from U.S. U.S. Congress, Senate Special Committee on the Investigation of Silver, Silver Part 5, 76 Congress, first session. Washington, D.C., GPO, 1939, April 7, 1939, page 196 to 197. The contraction of credit had a disastrous effect. Oh, sorry. Let's try that again. The contraction of credit had a disastrous effect on the nation as a whole, not just farmers. But the farmers were more deeply involved because the recently created Federal Farm Loan Board had lured them with easy credit, like ducks at a pond, into extreme debt ratios. Furthermore, the large city banks, which were members of the system, were given support by the Fed during the summer of 1920 to enable them to extend credit to manufacturers and merchants. That allowed many of them to ride out the slump. There was no such support for the farmers or the country banks, which by 1921 were falling like dominoes. History books refer to this event as the Agricultural Depression of 1920 to 1921. A better name would have been Country Duck Dinner in New York. Building the Mandrake Mechanism. In Chapter 10, we examine the three methods by which the Federal Reserve is able to create or extinguish money. Of the three, the purchase and sale of debt-related securities in the open market is the one that provides the greatest effect on the money supply. The purchase of securities by the Fed with checks that have no money to back them creates money. The sale of those securities extinguishes money. Although the Fed is authorized to buy and sell almost any kind of security that exists in the world, it is obligated to show preference for bonds and notes of the federal government. That is the way the monetary scientists discharge the commitment to create money for their partners, their political scientists. Without that service, the partnership would dissolve and Congress would abolish the Fed. When the system was created in 1913, it was anticipated that the primary way to anticipate, let's try that again. When the system was created in 1913, it was anticipated that the primary way to manipulate the money supply would be to control the quote reserve ratios and the quote discount window. That is banker language for setting the level of mandatory bank reserves as a percentage of deposits and also setting the interest rate on loans made by the Fed to the banks themselves. The reserve ratio under the old National Bank Act had been 25%. Under the Federal Reserve Act of 1913, it was reduced to 18% for the large New York banks, a drop in 28%. In 1917, just 4 years later, the reserve requirements for Central Reserve city banks were further dropped from 18 to 13%, with slightly lesser reductions for smaller banks. That was an additional 28% cut. There's a footnote about that. So in 1980, statutory limits on reserve ratios were eliminated altogether. The Federal Reserve Board now has the option to lower the ratio to zero, which means the power to create unlimited quantities of money. It is the ultimate dream of central bankers. It quickly became apparent that setting reserve ratios was an insufficient tool. The latitude of control was too small and the amount of public attention too great. The second method, influencing the interest rate on commercial loans, was more useful. Here is how it works. Under a fractional reserve banking system, a bank can create new money merely by issuing a loan. The amount it creates is limited by the reserve ratio or fraction it is required to maintain to cover its cash flow needs. If the reserve ratio is 10%, then each $10 it lends includes $9 that never existed before. A commercial bank, therefore, can create a sizable amount of money merely by making loans. But once the bank is, quote, loaned up, that is to say, once it has already lent $9 for every $1 it holds in reserve, it must stop and wait for some of the old loans to be paid back before it can issue new ones. The only way to expand that process is to make the reserves larger. That can be accomplished in one of four ways. One, attract more deposits. Two, use some of the bank's profits. Three, sell additional stocks to investors. Or four, borrow money from the Fed. When banks borrow from the Fed, the fourth option is the most popular and is called going to the quote discount window. When banks go to the Fed's discount window to obtain a loan, they are expected to put up a collateral. This can be almost any debt contract held by the bank, including government bonds, but it commonly consists of commercial loans. The Fed then grants credit to the bank in an equal amount to those contracts. In essence, this allows the bank to convert its old loans into new, quote, reserves. Every dollar of those new reserves then can be used as the basis for lending $9 more in checkbook money. The process does not stop there. Once the new loans are made, they too can be used as collateral at the Fed for still more reserves. The music goes round and round, with each new level of debt becoming reserves for yet a higher level of loans, until it finally plays itself out at about 28 times. Wow. Okay, so there's a footnote on that. See chapter 10 for details. That process is commonly called, quote, discounting commercial paper. It was one of the means by which the Fed was able to flood the nation with new money prior to the Great Dam Rupture of 1929. But there is a problem with that method, at least as far as the Fed is concerned. Even though interest rates at the discount window can be made so low that most bankers will line up like ducks looking for free corn, some of them, particularly those, quote, hicks in the country banks, have been known to resist the temptation. There is no way to force the banks to participate. Therefore, the banks themselves are dependent upon the whims of their customers, who, for reasons known only to themselves, may not want to borrow as much as the bank wants to lend. If the customers stop borrowing, then the banks have no new loans to convert into further result. Sorry, uh, banks have no new loans to convert to further reserves. So, in other words, just a side note, the way banks make money is through loans. And the only way they can make loans is when we the people borrow. So if we stop borrowing, let's say we use cash, we spend only what we make, or we spend less than what we make, uh, you know, doing practicing sound money practice, right? The banks would the banks would cease to exist. They won't have any customers. I think maybe they would be forced to be honest, banks. I don't know. Interesting thought. But anyways, little squirrel there. Okay. Where am I? Okay. That left the third mechanism as a preferred option, the purchase and sale of bonds and other debt obligations in the open market. With the discount window, banks have to be enticed to borrow money, which later must be repaid. And sometimes they're reluctant to do that. But with the open market, all the Fed has to do is write a fiat check to pay for the securities. When that check is cashed, the new money it created moves directly into the economy without any concurrence required from the recalcitrant banks. But there was a problem with this method also. Before World War I, there were few government bonds available on the open market. Even after the war, the supply was limited, which means the vast inflation that preceded the crash of 1929 was not caused by deficit spending. In each year from 1920 through 1930, there was a surplus of government revenue over expenses. Surprising as it may be, on the eve of the Depression, America was getting out of debt. And that quote was from C. Robert T. Patterson, The Great Boom and Panic, 1921 to 1929, Chicago Henry Regnery Company, 1963, page 223. As a consequence, there were few government bonds for the Fed to buy. Without government bonds, the open market engine was constantly running out of gas. The solution to all these problems was to create a new market tailor-made to the Fed's needs, a kind of halfway house between the discount window and the open market. It was called the quote acceptance window. And it was through that imagery that the system purchased a unique type of debt-related security called bankers' acceptances. Bankers' acceptances. Bankers' acceptances are contracts promising payment for commercial goods scheduled for later delivery. They usually involve international trade where delays of 3 to 6 months are common. They are a means by which a seller in one country can ship goods to an unknown buyer in another country with confidence that he will be paid upon delivery. That is accomplished through guarantees made by the banks of both buyer and seller. First, the banker's bank issues a letter of credit guaranteeing payment for the goods, even if the buyer should default. When the seller's bank receives this, one of its officers writes the word accepted on the contract and pays the seller the amount of the sale. The accepting bank, therefore, advances the money to the seller in expectation of receiving future payment from the buyer's bank. For this service, both banks charge a fee expressed as a percentage of the contract. Thus, a buyer pays a little more than the amount of the sales contract, and the seller receives a little less. Historically, these contracts have been safe because the banks are careful to guarantee payment only for the financially sound firms. But in times of economic panic, even sound firms may be unable to honor their contracts. It was underwriting that kind of business that nearly bankrupted George Peabody and JP Morgan in London during the panic of 1857, and would have done so had they not been bailed out by the Bank of England. Acceptances, like commercial loan contracts, are negotiable instruments that can be traded in the securities market. Accepting banks have a choice of holding them until maturity or selling them. If they hold them, the profit will be realized when the underlying contract is eventually paid off, and it will be equal to the amount of its quote discount, which is banker language for its fee. Acceptances are said to be, quote, rediscounted when they are sold by the original discounter, the underwriter. The advantage of doing that is that they do not have to wait 3 to 6 months for their profit. They can acquire immediate capital, which can be invested to earn interest. The sale price of an acceptance is always less than the value of the underlying contracts. Otherwise, no one would buy them. The difference represents the potential profit to the buyer. It is expressed as a percentage and is called the quote rate of discount, or in this case, re-discount. But the rate given by the seller must be lower than what he expects to earn with the money he receives. Otherwise, he would be better off not selling. Although bankers' acceptances were commonly traded in Europe, they were not popular in the United States. Before the Federal Reserve Act was passed, national banks had been prohibited from purchasing them. A market therefore had to be created. The Fed accomplished this by setting the discount rate on acceptances so low that underwriters would have been foolish not to take advantage of it. At a very low discount, they could acquire short-term funds, which then would be invested at a higher rate of return. Thus, acceptances quickly became plentiful on the open market in the United States. But who would want to buy them at a low return? No one, of course. So, to create that market, not only did the Federal Reserve set the discount rate artificially low, it also pledged to buy all of the acceptances that were offered. The Fed, therefore, became the principal buyer of these securities. Banks also came into the market as buyers, not only because they knew that at any time they wanted to sell, the Fed was pledged to buy. Since the money was being created out of nothing, the cost did not really matter, nor did the low profit potential. The Fed's goal was not to make a profit on investment. It was to increase the nation's money supply. Huh. Interesting. Okay, we'll stop here for now, and we will continue our reading next week. And I hope you enjoyed that. It's very interesting. I like the duck story. That is kind of drives it home a little bit. Hmm. Okay, so I hope you guys all have a great day, great afternoon, great evening, wherever you are. And more importantly, have a great week. And we will see you next time for part 2. Okay, bye-bye now.